Hello everyone, and welcome to today's webinar on the challenges of small business valuations. Our presenter for today is Pasquale Raffanelli of Grassi & Company, who I'll introduce in a moment. My name is Andy DeZamba, and I'm the executive editor here at BVR. I need to let you know that your attendance today is eligible for 2 CPE credits. To receive the credits, you must complete and submit a brief survey on today's webinar at the conclusion of our presentation. A link to the survey is included with your registration email, and it's also available on the reading page for today's program. The survey will be active for 5 business days, and it will require you to fill in 3 4-digit CE codes. The codes for today's webinar are 8726, 7770, and 9236. Again, those codes are 8726, 7770, and 9236. I will announce the codes again later during the program. If you have any questions for our presenter, we'll take them in writing only. To do so, please use the chat function on the left side of your screen. If you're getting audio through your computer speakers, please note that the quality of your sound will vary depending on the speed and quality of your internet connection. If the sound quality is not satisfactory, please refresh your screen. That usually helps. If it does not, you can connect to the audio with your telephone. To do that, just call the phone number provided on your login email. Well, we're very happy to have our presenter with us today. Pasquale Raffanelli is Valuation Manager at Grassi & Company in New York, where he performs appraisals of privately held companies in a broad range of industries for purposes of estate and gift tax planning, marital dissolutions, shareholder disputes, buy-sells, mergers and acquisitions, and litigation support. He also does economic damages and lost profits analysis, as well as forensic accounting examinations. He's been a speaker at events such as the ASCPA Forensics and Valuation Services Conference and the New York State Society of CPA's Annual Business Valuation Conference. He's also written several articles, one of which was on small business valuation, published in a Business Valuation Update. With that, I'll now turn the program over to our presenter for today, Pasquale Raffanelli. Pasquale?
Thank you, Andy, and good afternoon, everybody. Just as a quick announcement, I'm fighting a little bit of a cold, so if I have a cough, I apologize in advance for that. So today we're going to talk about valuing small businesses. When we talk about small businesses, we're talking about companies with revenues somewhere between, let's say, 1 and 5 million, 1 and 10 million in nature. So the first couple of slides are just the disclaimer and the acknowledgments for sites and sources that some of the information may have came from, and my bio, which Andy had originally or already told you about. So we're going to go right into the presentation. Today we're going to start off with an introduction to valuations, just a very top-level introduction. Then we're going to go into valuing small businesses and sole proprietorships. We'll talk about some common valuation mistakes that we see, engagement considerations before taking on an engagement, especially a small business type of engagement. And then if there's time, there's a little case study that we'll go through. Okay. So the valuation process, and again, this is just broad general. It applies whether we're talking about a large company or a small company. We start off with the standard of value. What are we valuing? Are we doing fair market value, and fair value, intrinsic value, investment value, and we'll go over those in a minute. What is the premises of value? Are we doing a going concern or some business that's in liquidation or bankruptcy, some other setting outside of a business that's going to continue to operate into the future? We're going to look at the economic conditions and what impact they potentially might have as of the valuation date. Just like in any valuation, we're going to do a full-blown financial analysis. We'll make our normalization adjustments, compare it to the industry, do a ratio analysis, and hopefully be provided with projections by management to allow us to see where the business is headed. And then we'll apply the three approaches, and we'll discuss which approaches are more applicable than others when we go through that piece of the presentation. And then you come up with your conclusion of value. Okay. And I'm going through these first couple of slides a little quicker than some of the back ones, again, because it's just a top overview, which will leave us more time to discuss the small businesses and the nuances with those. Just like in any valuation, you're going to follow the Statement of Standards for Valuation Services, VS Section 100, the USPAP standards if you are an ASA licensed holder. And then state standards, because as we know, fair value is state-driven. Each state has their own definition of fair value. So if you're doing a engagement that requires the use of fair value instead of fair market value or one of the other standards of value, then you would need to not only know the underlying issues within the valuation, but you'd also need to know the state's issues. And typically we would rely on the attorney to help us navigate that if need be. Okay, so under the standards of value, as we said, we have fair market value. That's your hypothetical will and buyer, will and seller transactions that are going to happen at arm's length, no coercion, no distress, no one being forced to participate in that transaction. The next one is investment value. That's where we're looking at synergies. So under investment value, we're looking to see if the transaction is going to produce some sort of synergistic value that would help the acquirer be able to maybe double or triple the revenues, possibly cut expenses, be able to use their current staff or their current facility in a way to help them generate more income to the bottom line. We have intrinsic value, which discusses potential growth. So once an acquisition happens, what is the business going to look like? Do we expect there to be some sort of added growth? Typically we see this when we're dealing with the buy-sells of publicly traded companies and where their future is going to be headed. And then you have best use value is just coming up with the best use of the asset on hand. And finally, fair value, which again, like we said, is state-driven. So each state has their own definition. For example, in New York State, when we're talking about fair value is discounts for lack of marketability, but not discounts for lack of control. And each state has their own definition. So even if you have value in a non-controlling interest, if it's fair value in New York State, you would ignore the potential use of a discount for lack of control. The next couple slides are just the definitions that we went over, so I'm just going to skip ahead to premises of value. So the premises of value, as we discussed a little while ago, we have going concern, and that's assuming that the business is going to continue to operate into perpetuity. It's going to continue to exist. It's going to continue to operate in the same manner that it has been in the past, and hopefully continue to be profitable. We have a combined asset value. That's when we have two companies that are going to potentially merge together and combine their assets. We have an orderly disposition. That's where the owners of the business, I'm going to say owners because it could be 1, 2, 3, multiple, but they decide that they are going to dispose of the business, or they're going to close its doors down, or exchange it for some other type of asset outside of business, or maybe even another business, but they're going to orderly dispose of the asset. And then finally, you have the forced disposition, liquidation, bankruptcy, situations where the company cannot continue to operate and they're being forced to close their doors. So the valuation date, we have the same issues when we're dealing with small businesses that we do with any type of business. And the valuation date becomes a very critical piece of the analysis, and we have to follow, as we all know, the known or knowable as of the valuation date. So if something wasn't known or knowable, we cannot include it or consider it in the valuation, and that's true across the board, even with the valuations of small businesses. Again, with small businesses, we're going to look into the economic and the industry conditions. We're going to look at the local, the regional, the national, potentially, depending where the company does business and where their operations are. Again, just because it's a small business with revenues, $1 million to $5 million, $1 million to $8 million, we're not going to ignore these pieces because they still have a critical role within the valuation, and they still need to be analyzed. Again, financial analysis, this becomes critical when we're dealing with the valuation in general and specifically small businesses. We want to see how the company is operating by themselves, where they stand, what their ratios show, are they profitable, and then we're going to want to compare them to the industry to see how they stack up to the industry. Are they operating better than industry, worse than industry? And this is going to play an impact, as we'll discuss later, when we're determining the final market multiple and or cap rate to use in our analysis. So the question just came in on subsequent events. Aren't there some that you have to disclose in your report? Example, a stock sale. And the answer is yes. Depending on the subsequent event and how it affects the company going forward, you may or may not want to disclose of it in your report. So a perfect example is if we were doing a valuation as of, let's say, December 31st, and the company actually does does have a sale of its stocks, let's say 3 months later in March, and we know what that value is, we might want to disclose that in the report so the readers know that there was a transaction after the fact, this is what it is, and lay out the facts for them. Another example of something that we may or may not want to disclose in our report is if there's a big litigation that happened. Again, if it's after the fact, it's not going to impact our value because it wasn't known or knowable as of the valuation date, but we might want to make the reader aware of it, again, depending on the purpose of the valuation and the nature of the valuation. So again, those are disclosures that we're going to make to the readers, but items that won't have an impact potentially on the value. Normalization adjustments. So now we're still talking top level to some extent, but we're going to diverge a little bit into the depths of small businesses. And we see these items occur more commonly in small businesses than in larger businesses and public businesses. The larger businesses, public companies usually have a lot more regulations, a lot more people to answer to. Even a private company that's, 500 million, 600 million in revenues, they probably have a board that they have to answer to, multiple owners. It's not, a tightly knit company, one owner or 2 or 3 owners where they could put these discretionary items through. So when we're doing the valuation, we need to understand the financials. We need to look at the financials, dig into the financials, and determine what expenses are really legitimate business expenses and what expenses are potentially discretionary items. Discretionary meaning items that a hypothetical buyer may not put through the business. For example, a car. Is a car needed to run the business? If the answer is no, then it's plausible that someone else stepping into the ownership role may choose not to have a car on the books and pay for the car. So that becomes a discretionary item. Excess officer salary, that's an item. So we would do a compensation analysis and I use the ERI database, but there are many other sources out there. But we would determine if the salary they're paying themselves is reasonable. And in many cases, they are paying themselves below market value, so we'll increase it. So these aren't items that are always going to have a decrease in value to the financials, as a result, increasing the net income after adjusted. The adjusted numbers could go the other way. So if we have someone paying themselves below a market rent, we will increase the expense, as a result, lowering the net income. Non-operating or non-recurring adjustments, if there's a one-time item that's not going to recur, we'll want to remove that and adjust that out from the financials. If it's a non-operating item, so if the company has a revenue stream from, let's say, the source of selling a piece of equipment, and they're typically not in the business of selling equipment, that would be a non-operating type of income, so we would remove that. Again, ultimately what we're trying to come up with is the normalized adjusted net income, which we'll then use to build into the cash flows after removal of all discretionary items, non-recurrent items, non-operating items. And this usually poses an issue in small businesses because, again, small businesses are ripe to run these items through their business. They don't have a board to answer to. A lot of times they don't have partners that they have to answer to. They don't have the SEC that they have to answer to. So they're going to run these items through the business, therefore lowering their net income for tax purposes. And it becomes a very tricky avenue because unless you're doing a full-blown forensic audit as part of your valuation, either the budget, and we're going to discuss that when we talk about engagement requirements to consider when deciding whether you're going to take on the engagement, your budget may not have it in it to do this full-blown. So a lot of times we have to rely on management's representation. A lot of times the normalization adjustments depend on control or not control. So what I mean by that is if we're doing a control and interest and we need to come up to a fair market value for a control marketable or control non-marketable, we need to make the control and adjustment. If, on the other hand, we need to arrive at a non-controlling value, we have two options. Option one is to make the control and adjustments and then take a discount for lack of control. Option two is to choose not to make the control and adjustments. And if we do not make the normalization adjustments, we're taking the assumption that the income stream that's arrived under the historical financial statements is already the stream available to a non-controlling owner. Therefore, we do not need to take a discount for lack of control. So in a situation where we want to arrive at a non-controlling value, we're not engaged to do a full-blown forensic audit as part of it, and we're not sure if we can rely on management's representations, we might choose to go down that avenue and not even worry about capturing some and missing others. So the valuation approaches for small businesses are the same as for larger businesses. You have the asset approach, you have the income approach, and the market approach. The asset approach is typically going to be rejected unless we're dealing with a liquidation value, whether it be forced or orderly, or a very intense asset holding company where they're where they have very little to no income, and it's prominently based on the assets. In which case we would adjust them all, the assets to fair market value, the liabilities to fair market value, arriving at the net asset value. Excuse me. The next is the income approach, and then we have two options under the income approach. We can either do a capitalization of earnings, which is a single period, or we could do a discounted cash flow. While the discounted cash flow is the more applicable method and the more appropriate method, especially for valuing a small business, it's really prominent based on management being able to give us a reliable set of projections. Again, as we all know, projections are what they estimate. There's no way to prove whether they are or are not going to happen, but we have some tools in our disposal to test them. We could compare them to historical. If a company for the past 5 years has been growing by, let's say, 3% every year, and industry is looking at a 4% growth, and management all of a sudden is telling us the business is going to grow by 8%, is that reasonable? Well, we want to dig into it. We want to ask management why 8%. They've never grown more than 3%. Industry is looking at a 4% growth, so it's not some sort of industry-driven factor. The economy's been the same over the last couple of years and is expected to remain similar. Is there something that you're planning on rolling out, or a new product, expansion of the facility, something that's going to justify that growth? And if the answer is yes, then maybe the 8% is reasonable. If the answer is no, then we really need to consider whether or not we need to consider whether or not those projections are reliable. Okay. So a question just came in. Do you use the excess earnings method? I typically do not use the excess earnings method. I know a lot of practitioners that do. I typically use either the income approach and or the market approach. Usually the income approach and then the market approach if there's enough transactions. Another question came in, but doesn't the private company market approach give a control value from which you take a discount for control? What data do you use for that? So the private company transactions, it really depends, at least in my opinion, it depends on whether or not we made the control adjustment. But if I am going to take a discount for lack of control, I typically go to the BVR website and I use their merger stat discount for lack of control tool and database to arrive at that discount for lack of control. So I have two questions that are very similar. What do you do when management doesn't have projections, and what do you do if you and management cannot agree on forecasts? Walk away, adjust the discount rate. So I'm going to address these two questions as one because they're relatively the same. If management does not have a set of projections that they can give us, then I'm going to default to the capitalization of earnings approach based on the understanding that management cannot give us projections. I cannot make a set of projections because if I was to make the projections, then it's in essence as if I'm valuing I'm valuing the projections that I arrived at. So if management cannot give me a reliable set of projections and they have no means of doing that, when management says they cannot create a set of projections, my question is always, why can't you? You know, what don't you have? What's preventing you from creating them? And a lot of the times they've never created projections before and they don't know how to start. So I'll explain to them what a set of projections are, how one would arrive at them, the steps, the procedures, the assumptions that they would need to consider, the methodology. And then if they could arrive at projections, great. If not, I'm going to default to the capitalization of earnings. I wouldn't walk away from an engagement just because management and I cannot agree on a set of projections per se. Usually there's a reason why they're held up on that, and I would like to dig into it and arrive at what the reason is and see if we can't work together to, let them know what they're stating, what's historically happened, what we're seeing. Ultimately, though, if management and I cannot agree and I just don't believe their projections, the options are either to walk away or to make a extraordinary exception under USPAP, if you follow USPAP, where we would say, management gave us these projections, we would explain why we don't believe they're reliable, but we're going to make, this hypothetical, this extraordinary assumption, and if it turns out that they're not accurate, our value would be different. So those are your two options in that case. Okay. And then the market approach looks at recent sales of comparable companies within the marketplace. So we're going to look at the databases, and typically for small businesses, we're going to look at the BizComps, PratStats, the IBA databases. I'm not going to do a public company analysis. In order to comply with the standards, I'm going to look into the database to see if there are any transactions, and every time that I do, I never find enough public company transactions. But just to comply with the standards, I'll do the preliminary search. Under the other three databases, if we do have enough transactions to apply, then I'm going to apply the database. There really is no set rule on how many transactions you should have. The more the better, yes, but to some extent we want them to be tightly knit. So what I mean by that is, if I'm going to do a revenue search and I'm going to do, let's say, 10 times revenues, and my range is, let's say, $1 million to $20 million for my revenues, and I come up with 150 transactions, that's a good pool. But now if I was to narrow my search and I come up with, let's say, 30 transactions within a range of $1 million to $3 million, and let's just hypothetically say the revenues are $2 million, the 30 transactions, while it's substantially lower than the 150, it's in a much tighter range. So I'd rather use the 30 transactions between 1 and 3 million than the 150 transactions between $1 million and $20 million. And we're going to do other searches within the transactions to determine if they're applicable. Revenues is one, a description. Just because we have our NAICS code or SIC code doesn't mean that every company within that code is applicable, so we might want to eliminate them for descriptions. If our company is a profitable company, we might want to eliminate companies that are not profitable, whether they be negative EBITDA or negative income. A date range, we want to eliminate any transactions after our valuation date. So again, if our valuation date is December 31st, 2016, we're doing the valuation in the middle of 2017, we want to eliminate any transaction that took place after December 31st, 2016. And we'll arrive at a set of, at this point, comparables or companies that we believe are the most applicable. Once we have that set, and each of the databases gives us different multiples, price to revenue, price to EBITDA, price to net income, price to cash flow, we need to determine which of them is the most appropriate and how we want to apply that multiple. So a good way to do that is to use statistical tools. So we might use a coefficient of variation, and we might look to see which of the multiples has the lowest coefficient of variation. The lower the coefficient, the tighter knit the multiples are. So we might use that. So let's say we hypothetically say the price to net income has the lowest coefficient of variation, so we're going to use that multiple. From there, we may or may not need to adjust that multiple. And what I mean by adjusting it is determining whether or not that multiple that we're going to use is applicable to our company. So we're going to look at the financial analysis that we previously did and determine if our company is better than industry or worse than industry. Industry meaning its peers. If we determine that it's better, we might want to use a higher multiple. If we determine that it's worse, we might want to use a lower multiple. And there's different ways of doing that. You could determine the multiple's 5 times and they're better than industry, maybe a 6 or 7 times multiple. I like to use the quartile. So if, let's say, for a company that's on par with industry, a median multiple is applicable, maybe I would go to an upper quartile or a lower quartile if they're better or worse than industry. And there's other ways to go about doing it. A couple questions just came in. How far forward do you normally have small business owners project? I like to ask a small business owner to project 2 to 5 years. I do not ask them for any more than 5 years. The reason is the further out we go, the less reliable it is. The only reasons I would go out further than 5 years is if they expect some major change in the business structure in years, 6 or 7, something outside of year 5. I'd rather have them give me 2 or 3 years of really good, reliable projection than give me 5 years of mediocre projections just to give me 5 years. In reality, when we do the discounted cash flow, our goal is to bring it out a number of years that the business has reached stability. So if that's year 2, that's year 2. If that's year 8, then it's year 8. But I usually like to ask for 2 to 5 years. That gives me a good set of numbers. Is there a minimum number of transactions you will use for the market approach? For example, at minimum, use 10 companies for the market approach. There's no minimum that I typically use. I know some people do have minimums, whether it's 5 or 6 transactions, 10 transactions. I once heard somebody say they won't use the market approach if they have less than 20 transactions. To me, if I have 2 really, really good transactions, I'll use those transactions. The problem is with the databases sometimes, though, the information is being reported by outside people. We don't know if the information is being reported accurately or properly. So the more transactions you have, the better the pool is, because it's going to remove outliers. But if you're lucky enough and you find 2 really, really good comps that are identical to the company in every way, I'm not going to ignore the approach just because I didn't meet my minimum. Okay. Okay, so we discussed the asset approach and the income approach and the market approach top level. Okay, so discounts, these are just some typical ranges that we see. They're not by any means the be-all, end-all. I've, in many cases, used numbers outside of this range on both the high end or the low end. For my discount for lack of marketability, I usually go to the to BVR, and they have the Stout reports. I believe that's the new name of it. I know they recently changed the name. Andy, am I correct on that? Okay. So I believe that's the name of it, but it's the BVR database, and in it they have the DLOM calculator where you could go in and you put your company's information in, and it arrives at what they believe a reasonable DLOM is. Now, I might massage that and adjust it a little higher, a little lower, depending on factors, but for the most part, that's the range that I'm going to use for my company. So discount for lack of control, if it's a control and interest, no discount is taken. A non-control interest with no control and adjustments, I won't take a discount. And a non-control and interest with control and adjustments, from what I've seen, the range is usually somewhere between 0% and 20%. But again, I'm going to go to the database by BVR, and I'm going to look up my NAICS code or my SIC code, whichever I have, and determine what my discount for lack of control should be. Discount for lack of marketability. For control and interest, I know there are 2 schools of thought. One school, if you have a control and interest 100%, you should take no discount. I typically believe even at a fully control and interest, you should have a discount for lack of marketability. It's going to be much smaller, somewhere between 0 and 10% usually. Whether I do, for non-control interest, whether I make control and adjustments or I don't make control and adjustments, that does not impact my marketability, because discount for lack of marketability deals with how quickly can I liquidate the interest, turn it into cash. So typically, like I said, 25 to 35% is the range that I've been seeing. But again, there's many cases when you can go higher or lower. Oh, Andy got disconnected, but he just got back to me. He said, yes, it is the Stout study. I thought that was the new name of it. So thank you, Andy, for getting back to me. Okay. These are just some factors that affect discounts. We're talking about pool of available buyers and the size of the pool, the accessibility and reliability of the information, prospect for sale or public offering. What we're really talking about is what is hindering the shareholder from selling. So if there's a clause in the operating agreement that says in order for an individual to sell their shares, they first need to propose it to the individual investors. And the individual investors have 30 days to determine if they're going to buy it or not. And then they need to bring it up to the company level, and the company has another 30 days. And then if neither the investors nor the company choose to purchase the shares, they have 30 days to sell it on the open market, and if they can't sell in the 30 days, they need to restart the process. So that's a factor that's going to heavily affect the discount for lack of marketability, because marketability, again, is how quickly can we convert our shares to cash. And with all these hoops, we're looking at a minimum of 60 days, because we have to get through the first two level of hoops, which are each 30 days. And then we need to then go through the next set of 30 days. And if we don't sell in 30 days, we need to start back from square one. So we're really looking at what factors are going to affect us from converting our shares. The more negative factors, the higher the discount's going to be, the lower the value. So some control elements, some common elements that indicate control in the transaction. We're talking about what, and these are some of the common ones on the slide, but just the top level and in general, we're talking about what items can someone have control over. So if tomorrow you're a owner in a business, let's say you own 10%, and you decide to go to the managing owner who owns 90%, and you say, I want you to stop paying your car, your mortgage, and taking the $1.5 million salary every year that you're taking. If the owner turns around and says, you know what, I'm going to make all the changes, then you have control, because they're going to listen to you and they're going to make the changes. If they, on the other hand, which they more likely will, say, go jump in a lake, I'm taking my salary, I'm paying for my car and my mortgage, then you do not have control. And when you go to sell that, potentially, and again, it depends on what level the value is of each item, but potentially we need to account for that and take a discount to compensate the new owner that's stepping in for the fact that they're buying an interest in a business that they have no control over. They cannot make any changes, and they need to live with whatever the cash flows are that are generated to them. Okay. So the next section we're going to go into is small businesses. And we've discussed some of these items as we've gone through each of the other pieces, but we'll go into a little more detail. But before I do that, a question just came in. Tax effect in the DCF, your thoughts? So yes, I always tax effect my income stream, whether it be a DCF or a capitalization of earnings. And I always tax effect the adjusted financials. So what do I use to tax affect it? It depends. If it's a pass-through entity like your S-Corps or your LLCs, I'm going to use the Delaware Chancery model, and that's the model that I use to determine my tax effect. And that helps us to prevent the double counting that a C-Corp would have. In essence, your pass-through entity premium. If it's a C-Corp, I'm going to use whatever the going C-Corp rates are. I typically use the highest bracket, regardless of where the company falls, only because we don't know what the future is going to bring. But if it is a very, very small company that would warrant something less, I might consider using something less than the highest tax bracket. And again, for the Delaware Chancery, being that I do not know what the individual's financials are like, I again would use the highest individual tax bracket. So best case scenario is we over tax affected it, but again we don't know where their situation would fall, and again we're trying to figure out what the true value or the true cash flows would be. Okay, so for small businesses, the most common methods are the capitalization of earnings, which is your income approach, and your transaction approach, the market approach, typically IBA, BizComps, or PratStats. Your less common methods for a small business is the asset approach, or your capitalization of excess earnings, which is really a hybrid to some extent. Your public company guideline method, again, it's a small business. We're probably not going to find public companies of that magnitude. And the discounted cash flow, the income approach. And the little asterisk that I have there is, personally, I believe the discounted cash flow is really a more applicable method. The problem is when we're dealing with small businesses, a lot of times they do not have a sophisticated set of projections or cannot prepare a sophisticated set of projections, which would by default have us fall back to the capitalization of earnings. So it's the most common method only because it's used more, because management typically does not have a set of projections. But if they did, I would prefer and I would use the discounted cash flow rather than the capitalization of earnings. But the important thing is your income approach is the most common method that we're going to use. It's based on the cash flows that are available to the individuals, which is, at the end of the day, the most important piece of any business and the most important piece that a owner looks for. The market approach typically is more of a backup or a sanity check, assuming I have enough comps to apply it. In my opinion, there's more pitfalls with the market approach than there is with the income approach. So I personally like the income approach better. How do you weight the two methods, the capitalization of earnings and the market approach? So a question just came in, that's the question. So assuming I have enough comps to apply both approaches, and I do apply both approaches, I'm going to look at the values that I arrive at. And what I mean by that is, if the values are relatively the same, meaning let's say $5 million and $5.2 million, I'm going to weight them 50-50. And in a perfect world, the values should be relatively the same. There really should not be much discrepancy amongst the values. If we do have a discrepancy, typically, and I say typically because there always are exceptions to the rules, and I've stepped outside of, what I'm going to say, depending on the engagement and the case and the nature of it. But typically, I'll give more weight to the income approach than the market approach, because in my opinion, I believe the income approach produces a more reliable value because it's based on cash flows to an investor, and it's based on a capitalization rate based on market rates rather than a market multiple based on transactions that will report it to these databases, in which the databases, as far as I believe, do not do any due diligence on those to really determine if the information is accurate that they're reported. And unless the database or the individual reports things like synergistic values and things like that, you always have those potential outliers that we just might not have the answer to. So the next question is, what method do you use to adjust earnings to cash flow for working capital? So there is a couple of different ways to do this. One way is we could look back and we could look historically to see what the working capital ratio is. And if it's 3%, then I'll assume 3% as a working capital. If it's 5%, I'll assume 5%. Another way is to do a more formal statement of cash flow and look to see what the changes are year over year. Which way I choose depends on which method I'm doing. If I'm doing a capitalization of earnings method, a single period, I'm going to look back at the historical. I'm going to see what the historical working capital is, and that's what I'm going to use. If I'm doing a discounted cash flow and there are no real major changes within the assets or liabilities, again, I'll probably do a historical working capital percentage to that. It's easier to explain, easier to use. If there are major changes like debt repayment or an influx of debt that the company expects in another year or major CapEx, I'll use a statement of cash flows, and I'll have a historical statement, and I'll produce a projected statement, and I'll use that as my basis to determine what my changes in cash that are non-income related are, and that's how I'll determine how to arrive at the working capital to use in my cash flow statement. So, our capitalization of earnings, we really look at four basic pieces. What are the cash flows or the earning streams? So we've arrived at our normalized cash flows. What is the growth? If we're doing a discounted cash flow, the growth may fluctuate year over year, depending on what management's projections are. If it's a capitalization of earnings, just like I would use in my terminal year, a long-term growth rate, I'm going to use the same long-term growth rate in my capitalization of earnings. Typically, I like to use the 3%, which is equal to a long-term inflation. Usually, though, 2 to 4% is a safe percentage. It really does not account for really any substantial growth. But 3%, like I said, because it equals inflation, and the company will just keep growing steadily year over year. It will account in some sense for the really high peaks and the low dips, because we're not having any high spikes or any low dips. But if the company has always operated in the manner where they always return to an even plateau and they expect to return to that even plateau, that 3% will give us both revenues and expenses are growing by that. The life, if it's a capitalization of earnings, it's a single period, 1 year, but it's going to grow into perpetuity. If it's a discounted cash flow, we're going to present value it based on the number of years we go out, but again, under the assumption that the business is going to continue into perpetuity. And then the risk is the cap rate that we arrive at the end of the day. So the formula that we would use for the capitalization of earnings is our free cash flow divided by the cost of capital minus the growth of the free cash flow. So if we determine that our free cash flow is $1 million, we have a discount rate that we arrived at under our cost of capital method of 19%, long-term growth rate of 3%, it would be the $1 million divided by the 16%, and that would be our value. So the first piece, as we said, there are 4 pieces. The first is our cash flow or our earning streams. So in order to do that, we need to determine the real income in small businesses. And we started discussing this earlier. And this is a critical component or a critical piece because, again, small businesses tend to have discretionary items or perks, personal expenses, going through the business. So we want to cleanse the earnings. We want to remove the one-time, the non-reoccurring expenses. We want to remove the personal expenses of discretionary items, the auto payments, the mortgage payments, the items that any other owner stepping into the shoes of the business would choose not to pay. If it's a cash business, we might have to do a adjustment or an add back to cash. I had valued a pizzeria restaurant once, and we did a whole in-depth study and analysis where we watched the restaurant. We counted the number of boxes that came and go, the number of the tin cans. We had the attorney subpoena the records. for all the purchases made, and we were able to back into what we believe the true or a reasonable number of pizzas that were sold, meals that were sold. We took out an amount for spoilage. Boxes are destroyed, the tins are destroyed, food goes to waste. And we were able to determine what the true, or what we believe the true cash of the business was. And we would add that number back. And again, that's more prevalent in the small business because, again, they don't have people to answer to. They could do what they want with it. So at the end of the day, the cash flow is going to go in their pocket anyway, and now they're minimizing the tax expense, putting more in their pocket. If it's a matrimonial case, I might do a lifestyle analysis or a lifestyle review to help me determine the true expenses and the true revenues of the business. We always run into a case with small business of inadequate records. So what do we do when there are inadequate records and we cannot determine what the true cash or the true expenses are? We have a couple of options at our disposal. Option one is we walk away from the engagement and say we cannot value the business. Option two, we value the business based on what we have, and we put in there we were not provided with these documents. These records were either they refused to give them to us or they said they didn't exist. Therefore, we made assumptions based on what we know from the records that we had and what we believe based on where the industry, the economy, or the company is going, and we would make assumptions. And again, we would outline all of our assumptions in our report and make them clear to the reader. So there's no question in what we didn't have or what we did have and how we arrived at our conclusions. Okay, cost of equity. We would use it by determining the build-up method or the capital asset pricing model. Typically, I would not do a capital asset pricing model, the CAPM, or a weighted average cost of capital for a small business. I would usually save those for larger private businesses or public businesses, but they are tools that we have at our disposal. Typically, I would do either the build-up method 1, which is the CRISP data, which is the old Morningstar data, the Ibbotson data, which is now published by Duff & Phelps, or the build-up method 2, which uses the Duff & Phelps data. I personally like the build-up method 2 using the Duff & Phelps data. The reason I like that better is we are using metrics that Duff & Phelps put together where we are comparing our company to the studies that they produced of the 8 different factors, and we are coming up with a combined equity risk premium and small size premium that's combined. What that's doing for us is that's taken out a lot of the assumptions or a lot of the judgment that goes into a company-specific risk. And the reason that is under the build-up method 1, we're using the published data from the Morningstar information, a risk-free rate, a equity risk premium, a size premium, potentially an industry premium, which I'll get to in a second, and then a company-specific where we now consider all these factors of our company and the risks that we have yet accounted for. Under the Duff & Phelps, because we've used their 8-metric style, we've accounted for all of, or a majority of, the key factors. So unless there's some major impact or major factor that we have yet to consider, I typically would use a company risk premium of 0. And the reason being, like I said, outside of anything major, I've already counted for my company-specific risk. So it's one less item that I have to worry about defending if called to testify. The industry premium, here's the problem that I have and a lot of people have with the industry premium. The industry risk premium is, again, pulled from the studies done by Ibbotson, but those studies are on the public companies of the industry code. So unless you're doing a public company analysis and you're applying that, how can you apply an industry risk premium? Because on one hand, you're saying, well, there are no public companies that match my company, no public companies that are remotely usable for the market approach using the public companies, but on the same end, using the same pool of public companies, I'm able to arrive at an industry risk premium. It's kind of like on one hand you're saying they're good enough to use here, but they're not good enough to use here. So while I do know people that use it, unless I'm doing a public company analysis, I'm not going to use an industry risk premium if I was to use the build-up method. Regardless of whether I'm doing the CRISP data or the build-up method, I typically use the Duff & Phelps recommended risk-free rate and the Duff & Phelps recommended equity risk premium. So I would typically use those. I know they still publish the historical side and the supply side, and I still know many people that use the historical and the supply side. But I prefer the Duff & Phelps recommended equity risk premium and risk-free rate in my analysis. And I'll use that regardless of which build-up method I use. Okay. Here's an analysis that I just threw together of how I would arrive at the two multiples. In a perfect world, they should be very close like this. Every once in a while, I run into situations where they're not, but typically this is what I would arrive at. And these were numbers taken from an actual valuation that I did recently. Also, when I come up with numbers like this, I typically round my discount rate, but I round it to the nearest tenth. So using the build-up method 1, I would do a 17.7 discount rate. I'm not going to round that up to 18%, nor am I going to do a 17.67. I'm going to do a 17.7%. Under the other one, I would just do an 18%. Why don't I use the WACC? That's a question that just came through. The reason I don't use the WACC on a small private company is it takes a lot of time to do it and to do it properly. Again, when we're doing small companies, we just don't have that in our budget. So a large private company or a public company, I would use it or potentially use it, depending if the company has a substantial amount of debt or not. But in a private company, just the amount of time that goes into creating it would more likely than not put us out of budget. Another question just came through, why no company-specific risk in number 2? And that's what I was discussing before. Under the Duff & Phelps method, being that we are applying the 8 metrics that they use to our company, we've already did a pretty in-depth comparison of our company to the data, accounting for the risk when we come up with that equity risk premium, size risk premium that we see over here. So we've kind of already accounted for that. So unless there's any major change in the company, some other risk that we have yet accounted for, I would not add a company-specific risk because I've already accounted for it. So I would need some real major risk component to put anything other than 0 there under method 2. Under method 1, as you can see, I've used the 5% because in this case I felt that 5% is a reasonable number. And if you look, so to bring it all full circle, my equity risk and size premium under the Duff & Phelps was 14%. Under the build-up, my equity risk was 5.5%. My size premium, let's just say 3.5% for round numbers. It's a little higher, but let's say 3.5%. That brings us to 9%. I add another 5% for my company specific, and I'm at 14%. So, and they don't always all work out perfectly like that. Sometimes, you know, one might be 15 and one might be 14 or a point up or down. But in my mind, or in my opinion, based on, you know, my studies and my understanding of the databases and how they work, the method, that in a case like that, even off a point or two, you've already captured the risk. Especially as you're company specific, it's a judgment call. So you might have been a little aggressive or a little on the conservative side when you came up with that. So again, I know that's a little long-winded answer, but that's why I would not use a company-specific risk under the build-up method 2 in this example. But there are some cases, like I said, where you might. So in the CRISP method, did you use the 10th decile average, or when would you further break down the 10A, B, or the 10 decile breakdown? Do you ever use these? So typically, for my size premium under the build-up method 1, I'm using the microcap 910. That accounts for our smaller companies. It also takes into consideration the 10th decile, which are our distressed companies, companies that are in potential liquidation, companies that have other issues, startup companies, things like that. So do I ever go into the 10th decile? Yes. If I'm doing a startup company or an extremely distressed company or a company in liquidation, I would go down to the 10th decile because it's more applicable. Outside of that, though, for a company that I expect to continue to operate into perpetuity as a going concern, I'm more likely than not going to use the microcap 910 unless I'm dealing with a really, really large company that would cause me to go something higher. What are the extreme ranges of the company-specific risks you normally see under the CRISP method? That's hard to answer. The reason it's hard to answer, it really depends on the factors of the company. And it depends on the nature. So a startup company, I'm going to use something much higher than a operating company that's been in existence for a while. A startup operating company that has little to no background, little to no revenues, that may or may not be in their ramp-up phase, I might use company-specific risk somewhere between 30 and 50%. For an operating company that has longevity, that's been in existence, I don't know, maybe 4 to 8% is a typical range that I see. But it's not to say that I've gone lower in some cases and I've gone much higher in other cases. It just all depends on the factors and what we expect in the company. Unfortunately, there is no right or wrong way to arrive at it. There's no right or wrong method to arrive at it. I've seen people lump all the items together and do plus, for this one plus this one minus minus. I've seen some people do, 1, -1. I don't like to give numbers to it because the question becomes, well, how did you arrive at that number? So, I'll usually list my factors out and then determine if it's a positive or a negative factor, see how many positive or negatives I have, and then come up with a factor that I think is reasonable based off of that. I usually, again, outside of any real major reason to divert, I'm usually somewhere between 4 and 8% is what I've determined to be reasonable. All right, so these are just the Duff and Phelps published different 10 deciles. Like I said, I think the best to use is the microcap 910, but again, that's my judgment. These are the 8 factors that we've discussed previously. You have the market value of equity, the book value of equity, 5-year average net income, market value of invested capital, total assets, the 5-year EBITDA sales, and number of employees. So again, the more of these factors that we can use and incorporate, the better. If one of the factors cannot be used, that's fine. I'll just ignore it and I'll use the other factors. If I can't use any of the factors, then I'll divert back to the CRISP method. If all my valuations, even though I'm only showing one method in my report, I will do both methods. And the reason I'm doing both methods is I want a sanity check. Because even if I believe the Duff and Phelps is the better way to go, I want to do the sanity check of the CRISP. I want to see what company-specific risk I use, and I want to make sure that 0 is appropriate. Maybe 0 isn't appropriate. Maybe I do need to use some metric in my company-specific. So I will always do both methods. Okay, here's some typical types of risks that we see. These aren't the be-all, end-all, but they're some of the major risks that one would see. Okay, here's some more specific company factors that we look at. Again, not the be-all, end-all, but some additional ones. Okay. Andy, I think now's the time for you to come in with the next set of codes. Is that correct?
Yes. Yes. Thank you, Pat. I just need to remind our listeners of the CE codes they'll need for the survey to receive CPE credit. Codes for today's webinar are 8726, 7770, and 9236. Again, those codes are 8726, 7770, and 9236. You'll need those codes for the survey that you'll take at the end of the webinar. A link is on your registration email, and it's also on the reading page for today's program, where you'll also find the slide deck for today's webinar. Also, as a reminder, if you have any questions, please use the chat button on the left side of your screen. Okay, thanks very much. Back to you, Pat. Thanks.
Thank you. So theory versus reality. We've gone through the theory. We've arrived at the valuation. Excuse me. And we want to know, does this value that we've come up with make sense? Well, how might we go about doing that? One is the rules of thumb, the AICPA Business Reference Guide. Again, while it's not a approved valuation method, it is something we can do as a sanity check. What are they saying? Does our number come up relatively close? If not, why? Maybe there's a valid reason, but we need to be able to understand it. Business brokers. So I'm sure we all have in our Rolodex of people to call, business brokers that we can reach out to from time to time if we're unsure or we have a question. And I've done that, not in every engagement, not nearly in every engagement, but from time to time when I want a sanity check, I'll reach out to one of my colleagues, one of my contacts, and say, from what you're seeing, these businesses on the market, again, without giving out any client information, is the number that I'm arriving at reasonable that you could take to market with? Payback period, how many years is it going to take for the investor to receive their money? 3 to 5 years is probably a reasonable payback period. Could be longer, could be shorter. It depends on the factors, depends on the circumstances, depends on the deal that's being structured. But if it's going to take you 10 or 12 or 15 years to recover your money, then is it really a wise investment? Maybe it is for other reasons, but from a money standpoint, you're not going to start receiving any dividends until year 13 or 14, whatever the case might be. Okay, the market approach. So we've discussed this in a little detail before. So now we'll just bring it into context of a small business. So first we're going to do a subject company analysis. We're going to understand the business operations of the subject company, the business segment, the customers, the management debt, the products, and all of that is important information in order for us to be able to determine if not only the NAICS code, SIC code that we've selected is appropriate, but two, once we're in that code, to see if the comps are reasonably appropriate to our company. So, for example, we go into a database and we're dealing with, let's say, engravers that engrave plaques. And within that SIC code, let's say we see engravers that engrave plaques, but we also see engravers that do tombstones or engravers that do door collars. Is that the same as a plaque? Maybe it is, maybe it isn't, but more likely than not, I'm probably going to reject the tombstones and the dog tags and deal solely with engravers of plaques. Now, one might say you're artificially reducing or eliminating companies that outside of their description may have been applicable, and maybe that's the case, but again, I'm looking for a pool that's reasonable, and if I can't find a reasonable pool, I'd rather reject it than use comps that may or may not be appropriate just to say I did the market approach. We have to analyze and adjust the subject company's financial statements, which we've already discussed in our normalization adjustments. Financial comparison to the transactions. I'm going to look at the size, my sales, my profits, my total assets. historical growth, ratio analysis, profit margins. All of this is used to help me determine, am I better than industry, am I peers, or worse than my peers? And that's critical and is important because at the end of the day, the multiple that I'm applying, I need to account for that. And if I'm much worse than my peers, and this multiple came from my peers who have transacted in businesses, and I'm worse than them, how can I use the same multiple that they used, and how can I say my business is worth just as much as their business is, when for all the factors that we've discussed previously, my business is really worse than their business, or better, depending on how it goes. Okay. So these are just some more things I'm going to look at. Okay. So select the appropriate valuation multiple. Consider if any adjustments are necessary to valuation multiples that are obtained from the transactions. We discussed that. Apply the selected multiple to the subject company. Again, how do I determine the appropriate multiple? There's different ways to do it. The way I prefer is the coefficient of variation. Again, it's a statistical metric that takes your average divided by your standard deviation, and it looks at all the transactions and says, you know, how widely disparate they are. So the lower the coefficient, the tighter those multiples are going to be, therefore removing a greater chance of any outliers. I'm going to add back that I have any assets or liabilities as required by the database used. So each of the databases gives us a set of instructions that says, well, if you use the BizComps database, you're going to add back these items. And if you use the PratStats, you'll add back these items. So I use the tool that they give. And what's good about all three of the databases, the BizComps, the PratStats, and the IBA, they each have a analyzer tool. So you, instead of just downloading the comps and having to study them and analyze them, you download their analyzer tool and you put in your company's metrics, and when you hit the search button, it gives you the comps that they believe are the most applicable based on the criteria you entered, whether it be revenue or assets or a description. From there, I always go through and make sure that there's nothing else I want to eliminate, and vice versa. I'm going to go through the ones that were eliminated and make sure that maybe I was too narrow and maybe should broaden it a little bit. But once you get past that, then you bring it over to the next piece, and in the next piece, they do the coefficient for you because they believe, just like I believe and many other people believe, that the coefficient of variation is your best line of defense on picking your multiple. So they do that whole analysis for you, and then you put your company information in, and it applies the multiple for you, and you then give weight to which of the multiples you want. Maybe you'll give 100% weight to the one with the lowest coefficient. Maybe you'll pick 2 or 3 because they all have low coefficients, or all the values are reasonably in line, which I've seen sometimes, and I might give even weight to every single one of the approaches. Then they tell you what assets and liabilities to add back, and again, you just put your company's information in, and it arrives at the concluded value for you. And I don't mean to be a proponent and a seller of BVR, but those are the tools that I use when I'm doing small valuations, and they are great tools. So what are some of the potential mistakes and or misunderstandings of the database that would lead to an unreliable market approach? So one is making a stretch in business similarity. So again, the engraver of plaques using the dog tags, or the engraver of the headstones, the tombstones. Using transactions that were in a different economic or industry cycle. Not knowing that the transaction price includes a strategic premium. Again, some of the databases give us that information, some of the databases don't. For the ones that do, again, it's only given if the information is provided. So if we do not know if there was a strategic premium, just because it's silent doesn't mean one was not used. And again, that's why I was saying the income approach, in my opinion, gives a more reliable value because we don't have to worry about these types of issues. We can only know what we know. Okay. not knowing or guessing at what assets and liabilities were transferred. Again, that would be in the case where you don't use the tool, you don't look to see what assets and liabilities are transferred, and you just say, well, I have a multiple, I'm going to add back these assets, subtract these liabilities. Again, you want to make sure what you're adding back is appropriate. Okay, and there's just some other factors here, but in an effort of time, because other things I want to get through, we're going to move forward. Okay. All right, so other common value mistakes, errors due to lack of attention to detail. Now, we're stepping outside of the individual approaches, and we're just talking about valuing small businesses in general and the common value mistakes. But before I do that, a question came in. How do you account for taxes for a pass-through entity? So, good question. I account for taxes by using the Delaware Chancery model. So by using that model when I'm doing a pass-through entity, it takes into consideration the corporate rate, it takes into consideration the personal tax rate, and comes up with a blended rate, which allows us to come up with a tax rate that is not double counting. Other ways to do it, which I do not do, but other ways that I know people that do it is, they'll use a corporate tax rate and use one of the pass-through entity models to arrive at a pass-through entity premium. At the end of the day, and I haven't tested it, but assuming they're all done properly, you should relatively come up to the same pass-through entity premium status, because it's just a different way of calculating it, but still using the same type of information. But again, I use the Delaware Chancery model. It's a very common one approved by the courts. After looking at and analyzing the other ones and studying the other ones, it's the one that I feel is in my opinion, is the most appropriate to use. Errors due to lack of attention to detail. Using the incorrect standard of value. We're supposed to be doing fair value, and we do fair market value. Well, that's a big issue. New York State, non-controlling interest. You're applying a discount for lack of control under fair market value. Fair value, you're not. Incorrect premises of value. We're supposed to be doing liquidation, and we're doing a going concern. Wrong valuation date. All of our multiples, cap rates are going to be off. We just didn't understand the facts. Errors due to insufficient effort or budget expertise. Again, we did inadequate qualitative and quantitative analysis. As we've discussed through this process, there are both quantitative analysis, where we're talking about the numbers, and qualitative, where we're talking about key man discounts, depth of management. No numbers are attached to that, but it's a critical component in the valuation analysis. Lack of support for our normalization adjustments. We do not want to just make an adjustment because we believe the item should be adjusted out. We need to have support. If we're going to do an adjustment for compensation, have the report from whatever source or site you use that supports your adjustment. If you are going to remove an expense, have the backup. Management told me that this expense is a personal item. I added back these revenues based on this analysis. Something that, A, you have in your file if you ever have to go back and defend it. I don't know about you guys, but I know if I write a report today and somebody asks me a year from now what I did on that report without going back, I'm going to have no clue what I did. And unless I kept great notes and all the support on how I arrived at it, I may not even remember how I came to that conclusion a year from now. And sometimes these litigation cases go on 2, 3, 4 years. Some other errors: improper or indiscriminate use of the transactional database, improper allocation of a discount and a premium, failure to reconcile the value indicators. Just because you have two values doesn't mean we're always going to do a 50-50 split. Maybe we need to do 75-25 or 60-40 or 70-30, whatever the case might be. Maybe the income approach needs greater weight. Maybe for whatever reason, in this one scenario, the market approach needs greater weight. And it happens. There is no one right or wrong rule of thumb where it's always the income approach that's getting more weight. It really depends on the factors. Cross-examination. Anytime we do a report, even if it's in a non-litigation setting, we should always assume that it's going to go to litigation. There could be a lawsuit down the road 2 years from now, shared dissolution, a divorce, and they want to see all prior reports. So we did a gift tax valuation today, and 3 years later, now the couple's getting divorced, and all of a sudden they want to see all prior valuations. The valuation that we produced 3 years ago that we thought would never see the day of light again comes up. We're called to testify on the stand, and what happens? Hopefully, you kept good notes and you documented everything, even though it was a non-litigation setting, something that should never see the day of light. But it does. So we don't want to have any biases in our opinions or our writing. Our assumptions need to be documented. Delegation of work. We all delegate work to staff to assist us, to help us. Check their work. Don't assume that they're doing it properly. Research used and not used. Even if it's not in the report, because again, we're only going to put the critical things in the report, keep it in your notes. I looked at this database, or I looked at this study, and I did not believe it was applicable for X, Y, and Z reasons. Have a prior draft. All prior drafts should be deleted. Don't keep prior drafts. I know some people like to keep the prior drafts. It's not a good idea, because under discovery, it's all discoverable. And now they're going to question you, well, 2 versions before your final, you had a value of $10 million. Now you're at a value of $4 million. Where does the $6 million go? Procedures, checklists, they're good to have. I personally do not keep procedures and checklists. I know it's something that I maybe should, and I've been looking into. I do a detailed document inventory, and I do on all my work papers. If the method is not used, I indicate why it wasn't used, and in my notes. But I do not have a formal set or checklist that I follow. Make sure you're in compliance with all the professional standards. And key, make sure you collaborate with counsel, especially if it's already in a litigation setting, because the last thing you want is for you and counsel to disagree while you're on the stand. Make sure you've covered all that prior to getting on the stand. Engagement considerations. This is critical when we're taking on an engagement. I mean, how many times have we taken on an engagement, we set a price quote, and we're halfway through the engagement or a quarter of the way or coming to completion, and we're over budget, and we realize we're over budget. Or we take a step back because the attorney has a report and they say you've completely missed the boat. Well, what's going on here? Do you not understand the engagement? Do you even know what you're doing when you're doing these valuations? Because this is not what we had asked for. So I always like to have an in-depth conversation with the client before I engage them. Sometimes I know it's a little hard when we work at larger firms and we have partners that say, this client is a client of the firm, or it's a good friend of mine. I already spoke to them. I know what they want. Just do it. I always insist that I need to speak to the client. 9 out of 10 times after I explain why, they allow me to. Every once in a while, I get some pushback, and there are ways around that. We'll put disclaimers in our engagement letter saying that this is our understanding without speaking to the client, but based on information given to us by partners of our firm. If things are different than what was told to us, the price could be different. We'll work around that. But usually, after I explain why I need to speak to the client, they usually let me do. It's very rarely that I'm not able to speak to the client before starting. So what is the purpose of the valuation? The litigation or non-litigation? If it's a litigation, whether it be a shared solution, a matrimonial, lost profit, Typically, I do not want the client to engage me. I want to be engaged by the attorney. Why do I want to be engaged by the attorney? There's no accountant-client privilege, but there is attorney-client privilege. And by being engaged by the attorney, we fall under that umbrella. And I say for the most part, because there are some exceptions to the discovery rule, regardless of what it is, but for the most part, all the information is now non-discoverable. All conversations, all documents produced by the client are non-discoverable if it gets to that. If it's an estate in trust, typically I'm not doing a full-blown forensic audit. So I do not need to do a real in-depth analysis of the general ledgers. Look, I'm going to look at the general ledgers. I'm going to talk to management. I'm going to determine if I'm going to make normalization adjustments or not based on the nature, and we're going to move on. But if it's a litigation set-in, share solution, matrimonial, I need to make those adjustments because I need to arrive at the true income regardless of controlling or not controlling. So I need a bigger budget for something like that. Other procedurals needed. Is it a matrimonial case? Do we need to do a personal expense analysis? Do we need to do a forensic analysis on top of our regular valuation? What is the complexity of the analysis? Are we dealing with an operating company, or are we dealing with an operating company that has operations overseas in different industries that are being held by holding companies? You know, a typical fee for an operating company may not be applicable in that case. Need for third-party specialists. If I'm doing a real estate holding company, let's say, I'm not a licensed real estate appraiser. I cannot go in and determine the value of your real estate. So I'm making sure the client knows up front and in my engagement letter that this is the fee for the value of the holding company. It is not the fee inclusive of the real estate appraiser. You need to hire a real estate appraiser. If you want, I'll give you suggestions, but that's an additional fee. I want it all up front. I don't want the client to be surprised and say, well, that fee that you gave me of $7,500 is both yours and the appraiser and the real estate appraiser report. So we want all of that discussed up front. Who is the client? Key people, access and cooperation. A, we want to make sure we have no conflict of interest within the firm. 2, what is the access and the cooperation? If we're valuing a business for a 1% owner where there's 100 shareholders and the information is not going to be produced to us, well, how can I value the business? I want to make sure we're going to have the access and we're going to have the cooperation. Again, if I'm not, either I need to walk away or my fee needs to be substantially higher. Documents and information, again, the access and the quality of it. Am I in compliance with the standards? Am I doing a conclusion of value or a calculated value? Am I doing that conclusion, opinion, full-blown valuation, or a calculation of value where I'm given an estimation using one approach? Other standards that I need to consider before making a decision. Reporting compliance. What type of report am I issuing? Is it a detailed report? Is it a summary report? Is it an oral report? Who are the users of the report? Is it going to the IRS or trust and estate where I need to comply with the adequate disclosure requirements for gift tax purposes? Or is it for an internal purpose where the client just wants to know what their value is worth and it's not going to anybody but the management team? Time pressures. This is always a big one. The client calls you up and says, I need a valuation for X, Y, and Z reasons. Perfect. Excellent. Great. We could do it. I need it in a week from now. That's critical to know on the onset, because if you cannot do a valuation in a week because you have 10 other engagements that need to be done that week, or you're on vacation, or you don't have the staff, or you don't have the knowledge because you need to do extra research, or you just don't feel that you could do a full-blown engagement in a week, you probably don't want to take the engagement, because once the engagement letter is signed and you don't comply, you can potentially be sued by the client. So you don't want that surprise. Engagement letter signed, they give you the document, then all of a sudden they say, oh, by the way, I need that report in a week now. You want to know all that up front. Will costs outweigh benefits to be realized? That's just meaning, are we going to take a discount on this engagement? And if so, why? If we're taking a discount on every engagement and we're not making money, we shouldn't be doing that. Where we're losing money left and right, it's a bad business decision. But if we're profitable in all of our engagements, or the bulk of them, and we have this one attorney that comes and say, look, I really need you to do a favor for this client. You do a good job. I promise you I'll give you other work, and I'm not going to ask you to take a discount on it, but, I've never used you before. I do want to use you, but the client wants us to use someone reputable and at a low rate. Can you do it? So maybe you'll do it. You'll take that discount, take a little loss on it, and you'll get future work from him. You then need to weigh the next engagement. If the next engagement comes, it's the same song and dance, well, maybe he's not forthcoming, and it's always going to be like this. The next engagement comes, and you're getting full price for it, it was worth it. So you need to outweigh these, and that comes with, experience and doing these for a while. So obtain a copy of the tax return for 2 years or the most current internal financial statement. Why? You might spot risks, unexpected assets. You get an initial sense of the operations. Are we dealing with a company that's a small company or a large company? Do we have a lot of expenses? Do we have to do a lot of digging? Do the expenses, at least for the 2 years or 2.5 years that we have, do they make sense on a trend purpose? We could build our budget around this. After identifying risk factors, discuss them up front with the attorney or the client. This is always the hardest part, and the reason is, at this point, I'm having a discussion with the client and the attorney, if the attorney is necessary to be involved. And I'm asking them very tough questions that they don't want to answer. They don't want to answer it after we're engaged, let alone before we're engaged. I'm asking them, do they have any lawsuits pending? Have they had any lawsuits in the past? I'm digging into these risk factors. If they tell me that, yes, they've had 5 lawsuits in the past, and all 5 were done because of some illegal operation, I probably do not want to get involved with this company. But if they have 5 lawsuits that were just in the ordinary course of business, and this industry and this business is ripe for lawsuits left and right, it's a different discussion. Okay. I'm going to add that to my risk factors, but it's not a decision whether I need to walk away or not. Discuss expectations, the scope of work, the type of work, expected users, and costs. We've discussed that already. So a question just came in, so let me answer this. It says, when valuing a company that pays rent to a related party, what procedures do you do to determine fair market value of rent? I have used property tax market values as a property to determine fair market value of rent, and also a broker assessed value. I'm hoping that you don't get an appraisal on the real estate. Do you? No, I do not get a full-blown appraisal for fair market value of rent. If it's to a related party, I'll do a couple of things. One, I'll talk to brokers like you do. I'll look at the tax property assessed. That's another way. And there's a lot of free databases where you just type in, and I'm doing this for one now. It's the medical office building in New York City. So I typed in medical office space for rent, New York City in Manhattan. I got 130 hits or so of companies or office space that's being rented. So now I have a really good pool of what the going rate is in the New York City market, and I might use that as my, and I typically would use that as my rent. I always put a clause in the report that I'm not a real estate appraiser. Real estate is not my forte. Therefore, this is an estimation based on public information available to me. The real fair market value rent for this property can be higher or lower. So it's an assumption, but it's backed by supportable facts, not a number I just pulled out of thin air. Okay, so a mini case example. I know we're running up against the clock, so we'll go through some of this. We'll see what we can get through. Otherwise, the slides are there for your disposal, and you could look at it. So here are the fact pattern. Dewey, Cheatham, and Howe, LLC, DCH, has 3 equal partners. The agreement calls for the sale of the shares by any partner at fair market value based on a valuation report. Those are usually great valuation clauses. We're not stuck with an outdated formula from 1940 that either is not applicable today or puts one partner at a disadvantage. It's a fair market value based on a valuation report as of the date. On 12/31/2016, Dewey retires and expects to sell his shares back to DCH LLC. In February 2017, so this is 2 months after, Cheatham and Howie informed Dewey that taxes for the years 2013 through 2015 were underreported and a large tax liability is incurred as of 12/31/16, reducing the value of the shares by 25%. Desperate for cash, Cheatham sets ablaze the warehouse of DCH, hoping for a quick insurance settlement. The inventory loss accounts for 30% of the value. So really what we're dealing with in those last two bullets is nothing more than subsequent events, which brings us to the next part of this. What is our valuation date inclusion and exclusion? So the valuation date, if we remember from the slide back, was 12/31/2016. So the tax liability is information that is known as of 12/31/16, the date of Dewey's retirement. It is unknown, it's unknown as of 12/31 because we found out about it 2 months later in February. But it is knowable by the partners, and therefore it's considered a part of the valuation of the shares. So it's known or knowable. While it wasn't known as the valuation date, it was knowable. They underreported their tax. They were hoping to get away with it. They didn't get away with it. The government caught up with them, and now they have to pay the penalty. So it was knowable. So that is included. The fire that followed the retirement is neither known or knowable. It wasn't known that a couple months later there was going to be a fire. It wasn't knowable. Cheatham was desperate for cash because of this tax liability and other issues. He didn't verbally go around telling everybody, I'm going to set ablaze to our warehouse. So it's excluded from the valuation analysis. So even though it has a substantial decrease in value, it was not known or knowable, and the retiring partner, in this case Dewey, should not be affected by that fire. Okay. So we're continuing with the fact pattern on the mini case. So DCH is located in any town in New York, doesn't matter where. It has 40 full-time employees who are all programmers. The company is privately owned. They distribute electronic components. The company has experienced a growth of 10% every year in gross revenues as reported in their financial statement. It's a GAAP-based financial statement. And the gross profit is consistently 30% for the past 5 years. Key things that we would have found out from our financial analysis. 10% gross revenues every year. So they've been growing, and they've consistently been growing. And they've had a consistent gross profit of 30%. Okay? So let's look at the income approach. So they have net income of $500,000. There's a one-time credit of $30,000. So that one-time credit would come out because we're not going to expect that credit going forward. Expense adjustments. We have some personal items of $60,000. Discretionary officers' compensation of $300,000. This $300,000 is what's above and beyond what should have been taken. So it's not like we're removing the compensation and not putting anything back. This is the amount above and beyond, the discretionary portion. So total expense adjustments of $360,000. So we have an add back of $360,000, a subtraction of $30,000, combined add back of $330,000. That brings us to a normalized net income of $830,000. Okay. So the income approach. Determine a capitalization rate and apply the capitalization rate to a normalized net income. Okay. So for simplistic purposes here, I just used some round numbers. A discount rate of 18%, a growth rate of 3%, gives me a capitalization rate of 15%. The capitalization of earnings method, again, is our normalized income divided by the cap rate. And that is a typo. It's not the 17%. It's the 15%. So I apologize for that. I didn't catch that till just now. But the $830,000 divided by our cap rate arrived at a value of the company before discounts, $5.5 million. So, staying with the fact pattern, let's assume that the fair market value of the assets is $1 million the fair market value of all liabilities is $400,000. And let's just assume that these are the assets, the fair market value of the assets and the liabilities based on the database that need to be considered. Okay? So we have a total net asset value of $600,000 under the asset approach. Okay. 1 million minus 400,000, 600,000. So now we have under the market approach. So again, in the next slide, I believe, we have the comps. We have the coefficient of variation over here of the 0.18, the 0.23. So in this case, the price of net income has a lower coefficient of variation. That's the multiple that I'm going to use. I go to the next slide. We have normalized net income of 830. I use a price to net income multiple of 5.37, which is my median, as we can see from the page before. And I come up with an indicated value of 4.4 million. Okay? Going back a slide, I had skipped the slide on purpose. So we determined that the fair market value is $1,400,000 of assets, $400,000 for liabilities, bring us to a net asset value of $600,000. We're going to assume that all the liabilities, according to the database, are liabilities that would be subtracted. We're going to assume of the million, only $850,000 of those assets get added back. And again, that's based on the definition within the database. So to my 4.5 million, I add back my 850,000 of assets, and I subtract the 400,000 of liabilities, and I come up to an adjusted value of 4.9 million. Okay. Let's hypothetically say I took a marketability discount of 20% and a lack of control for 10%. Okay. So here we see our three values: 5.5 million income, 4.9 market, 600,000 asset. I reject the asset approach. It's not applicable. In my opinion, the 4.9 and the 5.5 is close enough for discussion purposes to just average them together, and I come up with a $5.2 million value. To that, I apply a 20% discount for lack of marketability and a 10% discount lack of control, coming up to a concluded value of $4 million or $4.1 million. And then I pick then we would do the report, whether it be a detailed report, summary, or oral. So I apologize for going through the case study pretty quick. You guys have the slides. If there are any questions, please feel free to email me or contact me at any time. My contact information is on the last slide. A couple questions have come in. So, Andy, do I have time to go through them, or are we out of time?
Yes, you can take them. Take the two questions that are there, Pat.
Perfect. So small business valuations tend to imply small fees. How to reconcile small fees with work to be done in such valuations? That's very tricky, and that's why I go through that whole in-depth conversation with the client before I engage them. Because just because it's a small valuation doesn't mean I can cut corners or do less work on it for that. I still need to comply with the standards. I still need to do the full-blown work, whether I'm doing a valuation or a calculation of value. I need to follow those standards, those requirements. So you come up with a fee that is reasonable and appropriate. I do not base my fees per se on the size of the revenues. I base my fees on the level of work. And what I mean by that is if someone comes through with a small business, $2 million, $3 million, they don't have any financial statements, their tax returns are either in shambles or haven't been filed, I need to reconstruct the books and records before I could do it, I'm going to charge them a much higher fee than I would for a $20 million revenue company that gives me a nice package with bells and whistles on it, because the work's going to be less. And if the client doesn't want to pay for it, then they could choose to go elsewhere if need be. And hopefully, maybe they'll find somebody. I'm sure they will. But I'm not going to sacrifice, the standards and put out shoddy work just because they don't want to pay for the work. Two questions. The income approach, do you use free cash flow? It seemed that you just use net income. Second question, do you ever use harmonic mean and not the median? So in this example, yes. I made the assumption just for simplistic purposes that net income and cash flow were the same. In all valuations, I am using net cash flow, but again, for the example, just for simplistic purposes, I assumed they were one and the same. Do you use the harmonic mean, not the median? I've never used the harmonic mean. I've done some studies and some research into it. I know people who do use the harmonic mean. I know people who use a lot of statistics when they're doing their market approach, much more than just a coefficient of variations. And I've looked into those, and I've started considering using some of those. I haven't rolled them out yet, and the reason is I want to become fully versed in them before I just apply something. So right now, I am just using the median, but I am moving towards using more statistical methods within the market approach. And some of them, and again, I'm not being a proponent of BVR here, but some of them are already included in their data analysis package. Again, I'm just not comfortable enough with them just yet to use them, but I will be using them shortly. Question, why discount for lack of control after discount for lack of marketability? I didn't even realize I did that on that slide. I typically do discount for lack of control before discount for lack of marketability. That's a typo on the slide. I apologize. I did not even catch the fact that I did them in the reverse order. That's all the questions that I currently... Oh, another one just came through. Are there standard duties that are considered part of officers' compensation? That's a tough question to answer. I don't know if I would say that there are standard duties. I mean, it depends on what the person does. You have some people that wear multiple hats, and that needs to be considered. And we need to look at it and say, well, just because you're wearing multiple hats, A, would somebody else wear multiple hats? And if so, do we really need two people instead of one person? Or are you just wearing multiple hats because you need to have control over everything, and one person doing half of what you're doing is appropriate? So I always sit down with management. I ask them what they're doing in that position. Because A, I want to make sure that if they're acting as a president, that they're really doing presidential duties. Because if they're not, then maybe the president, while that's their title, isn't the real title of someone that's needed to run the business. Maybe it's the CEO, maybe it's the vice president. You know, I want to understand what they're doing, and I want to understand what they're doing to make sure that they're justified in receiving the salary. Maybe they need a higher salary because they're doing more and it's justified. Maybe they need a lower salary because they're not doing all the jobs that one would expect. But I don't know if I would say that there's a standard list that I'm going to follow in every engagement. So that answers all the questions. Again, you have my contact information. Please, any questions, feel free to call me, to email me. If I can answer it, I gladly will. Thank you again for listening in. Andy,
well, thank you, Pat.
Well,
great. Thanks very much, Pat Rapinelli, for a very fine presentation. I want to thank all of our listeners for attending. As a reminder, to receive your CPE credit, you must complete and submit a brief survey on this webinar and include the three codes, which are 8726, 7770, and 9236. A link to the survey is on your registration email, and it's also on the reading page for today's webinar. The survey will be active for 5 days, and you must complete it before we can process your certificates. After 5 business days, we'll process all surveys and send CPE certificates via email. You can find more information on future BBR webinars at bbresources.com/training. Our next program will be this Thursday, the 30th of November, where we will present the essentials of CAP-M beta. That's this Thursday on the 30th, so I hope to see you then. Again, thank you all for listening. Have a great rest of the day, and you may now disconnect. Thank you very much.